Hello and welcome back to Core Finance. I am Matt Brown. I'm joined by Vincent Deloire, who is a global macro strategist at INTL FCStone Inc. First time on the show, so welcome on the show, Vincent. It's an absolute pleasure to have you. And just for our viewers, can you just explain who you are and what you do for a living?
Sure. So I advise institutional investors, mostly pension funds, on asset allocation, country selection, sector rotation. My firm is a Fortune 500 broker-dealer, and I have 10 years of research experience. Before that, I was the head of the Europe product for Ned Davis Research, and quite happy to be on the show, especially after such an eventful weekend for European markets.
Fantastic. Well, thank you so much for coming on, and obviously you've got a wealth of experience, so you're obviously a busy man, so thank you again for appearing on our show today. Now, you mentioned Europe over the weekend, and we've had a lot of events, certainly with the German elections, but now looking at the European markets, they haven't really moved that much. So the question to you is, are the German elections important, and how long will it take for investors to really digest what's taken place over this weekend?
Well, I mean, you have kind of two phenomena going on. One is a general lack of volatility that we observe over every asset class, every market. Volume in Europe is at the lowest it's been since the internet bubble. You look at the VIX, it's in the US in single digits. So markets don't get rattled the way they used to in the past, 5, 6, 7 years. The geopolitical risks are being discounted. Mm-hmm. So that's the first aspect. The second aspect is that, yes, the German election was important, but it doesn't change all that much. I mean, ultimately what this election was about the junior coalition partner in the fourth Angela Merkel government, which, just a mouthful to say that, right? Mm-hmm. So, and there were some surprises. CDU coming up a little weaker, SPD being very weak. If you want to be a news junkie, people like to focus on the AfD, the alt-right party in Germany, doing 3 percentage points higher than what was thought. But again, as far as policy goes in Europe, this is the fourth mandate that Angela Merkel wins. This is a lot of stability, a lot of continuity. You have a very central tradition in German politics, as opposed to maybe the Anglo-Saxon system or the American system, where there's a little bit of theater and clash, and people really don't want to cross the aisle. I mean, Germany is the exact opposite. I mean, again, all of the parties that fared well in the election, with the exception of AfD, could have been part of a coalition. It's just a matter of arranging the colors. So now people get excited about the Jamaica coalition, because mm-hmm. of the colors of the flag, green, black, and.
I mean, just looking at obviously that election, but we're also seeing kind of the Macron effect, and there's a bit of a normalization now taking place, not only politically but also in the ECB's policy. So we're looking at, I mean, if we go back a few years ago when we saw what would be conceived as an unstable Europe, it feels now we have a bit more stability in Europe, and yet we're, in comparison to US equities, we're seeing European equities looking undervalued in comparison.
Yeah, no, they still do. So, I mean, if you look on a price-to-book ratio, the US stocks trade for about 3 times book, European stocks trade for about 1.5. So you're getting really a 100% discount, 100% premium for US stock, 50% discount for Eurozone stocks. And part of that discount, also the fact that Europe tends to be biased towards low margin, low multiple businesses, telecom, banks. We don't have the FANG, right? I mean, the whole story of the past 3 years in the US has been these 5 or 6 large cap tech stocks that have done extremely well. And by and large, we don't have that in Europe. Mm-hmm. That being said, the European discount is not reducible to a sector composition effect. even if you assume that the European market had the same sector structure as the US, you would still find that it would be cheaper. So there's about 20-25%, depending on which valuation metric you're looking at, PE, trailing, forward. But again, there is a 20% relative value opportunity in Europe that is not there in the US. And it's quite confusing to me, especially since that discount has widened this year.
And this is despite the fact the euro has strengthened against the dollar this year.
Yes. So, I mean, if you rewind the clocks prior, to early December, something like that, prior to the Macron election, there was this. The dominant narrative back then was, U.S. growth was going to accelerate. We're going to have tax cut, infrastructure spending. Conversely, Europe was kind of stuck with this populist crisis, never-ending recession, and so forth. Fast forward 6 months, everything has gone right for Europe. A lot of the Trump hopes have faded. If anything, it's in the US that we're seeing gridlock and probably a lot of political risk as well. Conversely, Europe, we had the Macron election. I mean, I don't want to make too much of a deal out of it. Part of it was lucky, but it was the right message at the right time. You had economic acceleration. Earnings growth has been stunning in Europe. I mean, year over year, European earnings are growing by more than 30%. In the US, in the high single digit. So everything's gone right for Europe. And the performance of equities has been good in the first half of the year, but since then, not so good, kind of flatlining. And part of the reason that the strategists have been invoking is the strength of the euro, which to me seems like nonsense, because 6 months ago, the very same strategists were making the same point about the strong dollar, justifying the high valuation of US stocks. So back in 2016, it's like, yes, US stocks are expensive, but they are denominating in a strong rising currency, so they are worth the premium. But the same logic doesn't seem to apply to European stocks. If anything, you see the exact opposite. People say, well, you got to buy US stocks because the dollar is weak, so their foreign earnings will look better. So you have a little bit of an asymmetry in the approach here, which to me really speaks to the opportunity for especially foreign investors to go into Europe, continental Europe. Because, I mean, from the perspective of a foreign investor, it really doesn't matter all that much whether the stock market goes up or the currency goes up, as long as you don't hedge the currency. Whenever you buy a share of a European company, you also buy the underlying currency. So dollar returns of European equities are still extremely strong, and I would expect them to keep being strong.
Understood. And so could we see a potential trade here of shorting US equities versus going long European equities? Would that be a trade you'd be looking at doing?
So that's the trade that I've recommended pretty much since November, and I call that a double transatlantic pair trade. So that there was more to it. There was a pair trade on the equity side, which was long Eurozone, short US. And then there was the inverse on the bond side. So remember back then, it was in November, 10-year treasuries was about at 2.6%. The 10-year German Bund was at 0 or close to 0. So you had this historical gap in terms of yields between US treasuries and Eurozone bonds. And that gap mostly was based on the notion that, Donald Trump would have this magical power to just kickstart growth and inflation in the US, and conversely that Europe was going to be the new Japan, that would do QE forever, that would never have any inflation, and so forth. So the idea is that there's two ways you can play this difference in growth expectations between Europe and the US, and this underappreciation of European growth. One is on the equity side, where you buy a growth asset in Europe, you sell it in the US, so long Eurozone stock, short US equity. And then on the bond market side, you can play the other game with the treasuries, because treasuries, especially long-term treasuries, are fundamentally a bet on low growth and deflation. And if the market is wrong about Europe being stuck in this forever deflation, then you'll see normalization in Europe happen faster than people think. And you'll see, conversely, which is what we've seen all year long, in the US, a flattening yield curve. I mean, we went from 2.6 to 2.1 on the 10-year, despite the Fed's quote-unquote normalization policy.
Fantastic. And just finally, at the start of the show, we were talking about volumes being low. We're seeing volatility as well low as well. So do you think volatility will pick up, or are we in a period of continued low volatility across all markets?
And this is the biggest conundrum for any investor, really. This has been the widow-making trade. Yes, over time, volatility, people compare it to a rubber band, right? If you stretch it for a long time, eventually it will snap back. So it should be reverting. The problem is that it has not. I mean, there's this. I was reading the Wall Street Journal the other day. They were running this story of this guy who used to work at Comcast, quit his job, and basically became a day trader, just selling vol. And has been more successful than any hedge fund manager, just constantly betting on lower volatility. Now as an investor who knows about history, you want to take the other side of that trade, right? You want to be long volatility. Now the problem with being long volatility is that it's costly. If you buy options, you're gonna have to pay premiums, and of course these premiums end up out of the money, so you end up losing money. If you want to play it with the VIX, the term structure of the VIX has been rather upward sloping, so you keep buying expensive contracts, so you have a negative roll effect. So it's a hard trade to implement, and again, it has confused a lot of people. Eventually, yes, it would snap back. My personal advice, which I'm not sure on how much detail I can go here, but would be to not take a naked long position in volatility. Try to buy volatility where it's cheap and sell it where it's expensive, so that you don't have this problem of getting wiped out just from the negative roll effect. And one way to do that is by betting on the spread between options on indices, which are quite cheap, and then single stock options, which are quite cheap but not as cheap as they are on options. So you essentially bet on correlations coming back, which is another thing that has really puzzled me in the past 6 months. I mean, all the rage is about the shift towards passive and the rise of ETFs. People never trade single stock anymore. They only trade baskets of stocks or indices. And yet, if you look at the median correlation between stocks and their indices, is at a 10-year low. And that, to me, that seems to make absolutely no sense. And maybe that's one of these areas where I can put a small volatility trade around correlation rather than the absolute level of volatility.
Super. Well, lots of trade ideas there. Vincent Delaloy, thank you so much for joining us. And hopefully we'll have you back on the show soon and we can discuss that volatility trade in a little more detail. But for now, thank you very much for joining us today.
It's been a pleasure. Thank you.